It's great to have you guys in. Welcome. Ali, I wonder what you make of Mester and Powell today, a bit of a hawkish tone. Is it surprising given that some of these break-evens are now at near 4-month lows?
Last week was an interesting week with the bounce we had, right? You had commodities down, you had inflation expectations down, you had expectations of Fed tightening down, and obviously the market liked that. What it was in response to, was that a real sustainable part of the market, or was it really sort of the flip of a coin we see every morning? So look, I think what's happening now is we had a great week with some great data. We had some very mixed or negative data come out earlier this week, including the consumer board numbers. You know, where we are at UBS is pretty simple. We have 4 scenarios, including stagflation, reflation, a slump, and a soft landing. And basically that gets you 50% to a down equity market and 50% chance of getting to a or up equity market. So this is going to continue. It's going to be a rough summer. As I said in my note earlier this week, my kids always ask me, are we there yet? My clients are asking me, are we there yet? We are not there yet.
Don't make me stop this car, is what you're telling clients. Jonathan, a lot of what we've talked about so far this morning is the negative tone on the sell-side research and numbers getting cut. Is that indicative of, are they late to the game, or is this a sign of what we might hear about Q2?
Well, Carl, everybody's talking about the numbers being cut. We track the numbers. They're not being cut. Here's what happens every single quarter. As you go into the quarter end, the companies pre-announce, they only pre-announce the bad news. So if they have good news, they hold it off. The estimates always fall, on average, they fall by about 4% going into earnings season. Surprise, surprise, you get a 4% beat and you're back to where you started. We are tracking above the long-term average. So we are not seeing this downward adjustment in the numbers. And the surprise is that in aggregate, the numbers keep sliding incrementally higher.
Do you think that we should see more downward revisions? Do you think that the market is adequately pricing in what we will expect from earnings season, which kicks off surprisingly in just about 2 weeks' time?
Well, I mean, this last quarter, we had a positive surprise by almost 7%. The prior quarter was 5.5%. I can't imagine that we're not going to have something in the ballpark of a 4 to 6% positive surprise. And if you look at how the companies are their estimates are actually coming down less than normal, all indications are that this is going to be a healthy earnings season, not the opposite. Are the numbers weakening in terms of economic data? Absolutely. But there's a difference between going from really strong to moderately strong as opposed to recession. And we're not in a recession camp yet.
Ali, I'm interested in this idea that, clients want to know if they're there yet. It strikes me in the prior decade even, people who served wealthy clients, individual clients, had to force them to take more risk for a long period of time. And now are you saying that they're essentially eager to either find out that their risky bets are going to pay off again, or that they want to kind of get more exposure to equities right now? Because it seems as if households are the one area of the market that haven't really quite unwound their equity bets.
Yeah, I would say on the sort of level of private wealth management that I deal with, the answer is both. People desperately want to know that things are okay with what they have right now and that they can jump in. And given, mind you, that for my clients, we're not talking about a time horizon of a day or a week or a month mark to market. We're talking about truly long term. But clients have forgotten, to your point, over the last 10 years, that they're not entitled to a portfolio return every year, that stocks and bonds can go down at the same time. And so there is this sense of anxiety. There is this sense of having too much liquidity, which I think is a great thing, which allows you to take risk. But when, thank goodness you have money market funds yielding 1 to 1.5%, but when inflation is 8.5%, it still doesn't feel that great. So I think what's happening here is people are trying to figure out, should I be staying in my macro hedge funds? Should I be investing in the commodity cycle for the long term? Or can I do what worked in the past and, waiting for that exhale?